Individual Disability Insurance. Individual Disability Insurance, DI, contracts are made directly between the applicant, who is both the insured and life insured, and the insurance company. These policies are typically used to replace earned income if the insured becomes disabled. They can also be used for business purposes, such as insuring against financial loss due to a key employee's or small business owner's disability. The premiums for personally owned DI policies are generally not tax-deductible, but the benefits received are not taxable. There are several types of individual DI policies, which are differentiated by their level of guarantees. These include non-cancelable policies. These policies offer the highest level of guarantees and are sometimes referred to as non-cancelable and guaranteed renewable contracts. The insurer cannot unilaterally cancel the policy, increase premiums, or reduce/modify benefits. The policyholder is the only one who can modify the policy, subject to underwriting. These policies typically run until age 65. At age 65, the policyholder often has the option to convert the policy to a guaranteed renewable contract with a shorter benefit period, usually 1 or 2 years, with premiums based on their age at conversion. Guaranteed renewable policies. The insurer is bound to renew the coverage each year until the maturity date, which is usually at age 65. However, the insurer can unilaterally modify premiums. Any changes must apply to the entire class of policies and be communicated in writing at least 30 days before taking effect. Cancelable policies. These policies offer the fewest guarantees. The insurer can change benefits and premiums based on the claims experience of a group or type of insured without the insured's consent. The insurer can also unilaterally cancel the policy, as long as the cancellation applies to the entire class of policies and not just one individual. Premiums for these policies are lower than for guaranteed renewable or non-cancelable policies due to the lack of long-term certainty. They are often issued to higher-risk occupational classes or individuals who were declined for other policy types. Guaranteed issue policies. These are individually issued policies that serve as an alternative to traditional long-term disability, LTD, group insurance. They are available to low-risk occupational classes like executives, lawyers, and doctors. They guarantee coverage for members of the target group but may have restrictions based on the group size, occupational class, minimum annual premium commitment, and minimum average age. These plans typically have higher premiums than traditional group insurance, and the insurer can terminate the guaranteed aspect of the plan at any time. There are 2 forms. Guaranteed standard risk. These plans guarantee that coverage will be issued without restrictions or premium ratings. To limit anti-selection, they usually require 100% participation from group members or that 100% of the premiums are employer-paid. Guaranteed to issue. These plans guarantee some form of coverage but not necessarily the exact coverage applied for. The insurer requires full medical underwriting and can apply premium ratings or exclusion riders for non-standard risks. Non-traditional disability insurance plans. These plans have emerged to serve the growing market of self-employed and contract workers. Some insurers now offer policies that cover loss of income due to either accident or sickness, but not both. Other adaptations include changing the definition of disability from being unable to perform job duties to being unable to perform specified functions or earn a certain percentage of regular income. Policies are also available for self-employed workers who are currently unemployed, with the definition of disability being the inability to seek new contracts due to illness or injury. Individual policy benefits. Individual DI policies vary based on the amount of benefit paid, when benefits start, and how long they are payable. Amount of benefit. To prevent the insured from being better off financially while on a claim, many insurers will not issue coverage that pays more than 60 to 66.66% of the insured's net pre-tax, pre-disability income. The benefit will be tax-free. Waiting period. This is the time between the onset of disability and when benefits begin. It is also known as the elimination period. The primary purpose is to avoid processing claims of very short duration, which require significant administrative effort and expense. Benefit period. This is the maximum duration for which benefits will be paid. The period starts after the waiting period has expired and continues until the insured can return to work or the benefit period ends, whichever comes first. Common benefit periods for long-term policies are 2 years, 5 years, 10 years, or to age 65. Short-term disability policies typically have a benefit period of 10 to 26 weeks. A longer benefit period results in a greater policy premium. Exclusions and limitations. Most policies have standard exclusions that apply to all insured individuals and are not specific to a person's health, vocation, or lifestyle. Common exclusions include disabilities from war, terrorist acts, self-inflicted injuries, attempted suicide, illegal activities, and normal pregnancy/delivery. Underwriting departments may also reduce benefits, shorten the benefit period, or increase the waiting period for applicants considered to be an unusual risk. Denial of benefits. Claims can be denied for several reasons, including misstatement of a material fact. A policy can be voided within 2 years of issue if the insured made a false statement or failed to disclose material information on the application. This 2-year period is known as the contestability period. A material misrepresentation is a fact that would have impacted the underwriting decision. Fraud. If an applicant intentionally misstates or fails to disclose information to deceive the insurance company, the insurer can void the policy at any time. Similarly, if the insured commits fraud when making a claim, the insurer can deny the claim and cancel the policy. Absence of loss. Benefits are only paid if there is evidence of lost income due to the disability. If the insured was unemployed or earning significantly less than their insured amount, benefits may be reduced or denied. Absence of proof. The disability must be medically proven. The insurer will request a report from the insured's doctor and may require a medical exam or other tests from a physician of its choice. For prolonged disabilities, periodic medical updates are typically required. Delay in filing a claim. A claim may be denied if it is not filed in a timely manner. The insured should ideally contact the insurer within 30 days of the disability's onset, and a claim must generally be filed within 90 days. Rehabilitation benefit. Insurers often encourage and may pay for treatments and retraining to help a disabled insured return to work. The policy may specify a dollar amount for retraining, and the insurer must accept the choice of educational program. Services covered can include physiotherapy, occupational training, medical treatment, job placement, and psychotherapy. Benefits for recurring disability. This clause is designed to prevent an insured from having to go through a second waiting period if they return to work and then suffer a recurrence of the same disability within a short period, usually 6 months. In this case, the 2 periods of disability are treated as one. Benefits for presumptive disability. This occurs when an insured suffers specific severe injuries or conditions, e.g., total loss of hearing, irreversible blindness, loss of 2 limbs, or total loss of speech, and is presumed to be disabled. The waiting period is waived, and full benefits are paid for the life of the benefit period, even if the insured is able to return to work. The insured does not have to prove a loss of income. Survivor benefits. Some policies offer a survivor benefit to the insured's estate if the insured dies while on a disability claim. A qualification period, such as a minimum of 12 months of disability before death, may be required. The benefit is a lump sum, often equal to 3 times the monthly total disability benefit. Individual policy premium factors. Premiums for DI policies are determined by a wide range of factors, including age and gender of the insured. Health and smoking status of the insured. Occupation and definition of disability used. Claims history of the insured. Length of the waiting and benefit periods. Investment returns on accumulated premiums and operating expenses. Morbidity tables, which are actuarial estimates of the risk of disability within segments of the population. Riders. Riders are special provisions added to a standard DI policy to customize the coverage. Future purchase option, FPO. This rider, also known as Guaranteed Insurability Benefit, GIB, or Guaranteed Insurability Option, GIO, gives the insured the right to purchase additional coverage in the future regardless of their health. The new coverage is based on the insured's attained age and the same occupational class as the original policy. The key restriction is that the insured must financially qualify for the additional coverage, which is typically limited to 60% of their earned income. Cost of living adjustment. COLA. This rider provides an annual increase in monthly benefits to keep up with inflation. The increase can be a simple flat rate or a compound rate based on the Consumer Price Index, CPI. Accidental death and dismemberment. AD&D. This rider provides additional benefits for death or specific severe injuries resulting from an accident. A lump sum, known as the principal sum, is paid for death, and a percentage of that sum is paid for other specified losses, e.g., loss of sight, hearing, or limbs. Partial and residual disability benefits. These benefits encourage disabled workers to return to work part-time. A residual disability benefit pays a portion of the benefits if the insured can work part-time after a period of total disability. A partial disability benefit may pay a portion of the total benefit from the beginning of a disability if the insured can only perform some of their job duties or works part-time. Return of premium. ROP. This rider addresses the concern that a policyholder may pay premiums for years without ever filing a claim. It provides for a tax-free refund of premiums paid if the policy expires and the total claims paid do not exceed the total premiums paid. This rider is expensive, often adding 40 to 60% to the base premium cost. Ratings and exclusion riders. If an applicant is assessed as a higher risk due to health or lifestyle issues, the insurer can decline the policy, impose a premium rating, an increased premium, or add an exclusion rider. An exclusion rider specifies that no benefits will be paid for a disability arising from the identified activity or condition. Hospitalization benefit. Riders can be added to cover extra expenses incurred during a hospital stay. A first-day hospitalization rider provides a daily pro rata benefit of the monthly DI benefit if the insured is hospitalized, bridging the gap during the waiting period. A hospital indemnity rider provides a daily cash benefit, e.g., $50 to $250 per day, for specific expenses like childcare or parking costs. Taxation of individual DI benefits. Generally, premiums for individual DI policies are not tax-deductible. and the benefits received are not included in taxable income. This applies to benefits, waiver/return of premium benefits, and treatments paid for by the insurer. Group disability insurance. Group disability insurance is provided to many individuals under a single master policy. In an employer/employee plan, the employer is the policyholder, and the employee is the life insured. And beneficiary. Group plans are a cost-effective way for employees to get a base for their risk management program. Group DI is offered to people with some commonality, such as working for the same employer, in the same industry, or being a member of the same association or union. Group coverage is typically divided into two categories. Short-term disability, STD. This covers disabilities of short duration, usually less than a year. Benefits are based on a percentage of salary, often 70 to 75% of pre-disability income, and are considered taxable income because the employer typically pays 100% of the premiums. The definition of disability is generally own occupation, long-term disability, LTD. This coverage takes over when STD benefits expire. The waiting period for LTD is the same as the benefit period for STD coverage. LTD monthly benefits are generally lower than STD, typically 50 to 60% of previous income, and are usually tax-free if the employee pays 100% of the premiums. The definition of disability is usually own occupation for the first 12 months, then changes to any occupation. An all-source maximum, or group offset amendment, is found in most group master contracts. It specifies that benefits from all disability income sources cannot exceed a certain percentage, often 85%, of the plan member's pre-disability income. If the total benefits exceed this limit, the group benefits are reduced. Creditor disability insurance. Creditor disability insurance is offered to borrowers to ensure that loan payments are made if the debtor becomes disabled. It is offered as an optional add-on to a loan and may have little to no medical underwriting at the time of application, though underwriting can occur retroactively at the time of a claim. The definition of disability is almost always total disability, which is the inability to earn income due to illness or injury. The premiums are typically blended with the monthly loan payment. Premiums are not tax deductible unless the loan is for a business or investment, and the benefits are received tax-free.